Jake, welcome to this masterclass.
Thank you.
For those viewers and listeners who haven't heard of you or the Atchison name, can you give us a brief intro to yourself and to the brand?
Okay. Well, my name's Jake Jodlowski. I'm from Atchison Consultants, or we call ourselves Atchison now. Drop the consultants. I am, you can tell from my accent, I'm originally from London. Worked in chartered accounting in London, specialised in tax, then moved into investments. And about 27 years ago, moved from London to Hobart, Tasmania, and started with a financial services company in Tasmania, which we grew, superannuation, financial planning, investment management. I was on the investment management side. We grew successfully, listed the company on the stock exchange in the mid-90s, and through subsequent acquisitions, became a $3 billion financial services company. I've been with Atchison's now for 10 years, and it is an independent consulting company. We consult to public office superannuation funds, property trusts, and wealth management groups, and also charities and non-for-profit organisations. My role there is I'm a principal there. I focus on building portfolios, client portfolios, investment portfolios, and also do a number of reviews on investment managers and suitable strategies for our clients.
So you're the perfect person to talk about some of these questions today. We're talking about ESG in particular, which I know is not necessarily your focus at Atchison, but it's something that you do come across quite regularly. I'm hoping for the first question you can answer, what are the potential sources of returns as they relate to ESG? And you could take this across equities, fixed income, however you want to take that.
There's no real difference between Australian equities, returns from Australian equities or bonds or listed property trusts, etc. They just have an ESG screen over the top where they exclude certain types of investments for ESG reasons, whether it's environmental, social or governance or all three. But fundamentally, there is no real difference. We are still looking for active returns for our clients.
How about on the passive side? Do you come across many passive funds that have the screening criteria as well?
We do. Speaking from experience, we were asked by a client to build an ESG portfolio. And we asked them, can you please provide us with your definition of ESG? They weren't able to. They just wanted basically an ESG product. So we designed an ESG product using 100% passive funds throughout the whole diversified portfolio.
Okay, so that's great to know that they can be built active or passive. I don't see as many passive in my experience, but I guess that's maybe something that we see coming down the pipe. Maybe there's more.
There are more passive coming through. There was a lack in the fixed interest space, but there are now more passive funds in the fixed interest space. I think BlackRock launched, Vanguard have launched passive products. And when we put together the diversified portfolio, the passive one, it was very cost effective for the client.
If we think about, so normally when we do these masterclasses, we talk about key determinants of success. We might be talking about active strategies, or we might be talking about passive funds that do a better job than active in some respects. But as it relates to ESG, and you studying maybe the investment process or philosophy of some of the managers or clients that you deal with, how do you think about what goes into making, I guess, a better than average investment process if they want to invest in a way that's responsible, sustainable, ethical, etc.?
I think the client has to understand from the onset that there will be a deviation in investment performance. And that could be on the upside or on the downside. So fundamentally, the start has to be, what's the client's ESG philosophy? And from that, we can go out and select suitable strategies that meet that philosophy, whether they're passive or active or a combination. At the moment, it's quite difficult in the marketplace to find the same type of ESG strategy across all asset classes. We've had one issue with a client, not an issue, but an institutional client where the word greenwashing has come up, where the ESG strategy is not being replicated, or philosophy is not being replicated in every asset class. So a client has to understand that their portfolio may not be 100% ESG. It may be 40% ESG or 10% ESG. So when we work with clients, we put together an ESG budget. So the client is aware that only 60% or 50% of the portfolio will be ESG at the moment. to a specific philosophy, and certain asset classes may not be ESG because there may not be the strategies available.
Sometimes when I look at ethical or ESG aware funds, sometimes the actual portfolio doesn't deviate that much from, a traditional fund, and that's maybe because the products simply aren't available,
or it's not clear. It's not clear. The philosophy isn't clear. It's blurred.
Yeah, right.
So from the onset, if you are selecting a strategy, you really need to look under the hood.
Yeah.
Understand what the fund manager is trying to achieve through ESG. Most fund managers will focus and have focused historically on the governance part, because that does have an impact on performance. Poor corporate governance, as we witnessed with, say, Crown casinos, or you can see where poor governance has really eroded shareholder value.
How about then, Jake, recently there have been reports that responsible funds, in particular active funds, have performed very strongly over a 5-year window, say. There are various reports on this from, say, like the RIAA. But more recently, if we just zoom in on 2022 as we record this, we've had the energy sector and the resources sector take flight, while traditional sectors, which may be considered ethical, air quotes, being, say, technology or software, they've taken a bath. In which market environments would you say having that ESG lens, I guess, produces outperformance, or at least market-like returns? And in which environments maybe is it more difficult to achieve those returns?
Well, you're right. You're saying if we look at 2022, materials and energy were the best performing asset classes or sectors. So if you're a fund manager, Australian equity manager, and you weren't holding any materials or energy stocks, you underperformed, full stop.
Yeah.
Irrespective of the stocks you were holding. So and then obviously on the flip side of that, a lot of ESG strategies do hold, as you said, technology stocks. So in an inflationary environment, what we've seen over 2022 is that with the inflationary environment, the technology stocks have come off, and the growth stocks have come off because they tend to be technology stocks, and the value stocks have come up, and the materials and energy stocks have come up. So it's basically inflation and interest rates have generated the underperformance or outperformance of certain stocks.
As a consultant and researcher, what are the more common questions that you might get asked by investment committees or financial advisors?
The first question would be, build me an ESG portfolio, Jake. We have got demand tends to be younger clients who are happy to have their superannuation contributions directed towards ESG, and also wealthier, older clients who have sufficient capital that generates them sufficient income in their retirement, but would like to do something a little bit better with their capital. So they're the cohorts, the type of clients we deal with. Again, we go back to the same thing. What's the philosophy? What's our ESG budget? Because you have to disclose. It will be good to disclose to your clients or their clients how much of that portfolio is actually genuine ESG, and what is the definition of ESG.
How about the question of what's the performance profile like? Do I sacrifice returns when I invest in an ethical ESG-focused strategy?
In our presentation to a client we did about a year ago, on the first page, there was a bullet point saying there will be deviation of investment performance from the benchmarks. And that may be on the upside or downside. So they should expect deviation. Over time, you would expect the portfolios to behave or mimic a non-ESG portfolio, fundamentally. And if we're talking about a diversified fund, rather than just Australian equities or bonds, 80 to 90% of the returns will come from the strategic asset allocation. So if the ESG portfolio and the non-ESG portfolios have similar asset allocations, over time, the performance will be very similar.
So variability sounds like one risk that investors should be aware of. Are there any other risks as it relates to ESG that investors should be aware of?
It's really, the risk is with the portfolio manager and how much resources they're allocating to the ESG research. Because that's fundamentally what we call an overlay over the portfolio. So some fund managers may not be sufficiently resourced to do sufficient research on the ESG part of the portfolio or of a stock or of a bond. And they may rely on third-party, off-the-shelf type ESG research that really is commoditized and not particularly specific to that fund manager. So there's a risk there. But we're seeing more and more within our industry, we're seeing fund managers recruiting more and more people with ESG experience. But still, it's in its infancy.
We talked off air a moment ago about benchmarking. So maybe you can talk about benchmarking risk, because I think it's kind of peculiar as we look at ESG funds and strategies.
Yeah, our preference is for fund managers, if they're running an ESG strategy, is to have a customized benchmark rather than benchmarking themselves against a broader one, which doesn't really make any sense. So if you're not holding materials and energy, why are you benchmarking yourself against an index or a benchmark that has materials and energy in it? You will always, then therefore you will either underperform or underperform.
Yeah.
So our preference is for fund managers to, once they have their ESG strategy, go to an index provider, and this is basically my investable universe, which makes up my benchmark. And from that, I select either the stocks or bonds from that universe.
All right, Jake, this is a final question, which is, if I was a financial advisor, I'm coming to you and I'm saying, my client is wanting to invest 10% of their portfolio into an ESG strategy, how would you expect that to change the risk-reward profile of a diversified portfolio?
Realistically, without running some numbers, I don't think it would change the risk-return profile. It would be minute, the difference. But what we would do, we would test that. So we have our own sort of what we call a mean variance optimizer or a black box, where we would input certain data, the total portfolio, run that through the black box, and out of that will come out certain characteristics of the portfolio. And part of that will be maybe the probability of achieving investment objectives, the change on the risk or the variance of the risk, and the probability of achieving certain percentages, etc. So we would test that.
So Jake, thanks for joining me for this masterclass.
Thank you for the time.